welcome everyone to episode 40 of Top of Mind. Happy New Year, everyone. It is January 9th, and we are recording our first episode of the year. Very excited to be back on the air with all of you today. And for today's episode, we are going to be focusing on the forecasting for 2023 that was so wrong. We went back and we looked at what all of the big banks, big firms said that 2023 would be versus what actually happened in the markets. And look, everybody was saying we've been a month away from a recession for X number of months. We said that. Everyone said that. Yep. And it seems like we were. And at some point we will be. But we just thought we'd go back to the data and share it with all of you because the forecasting game is the best guesser in the room. Second item is last year performance by category. I think you all find it very interesting what 2022 did in terms of returns by category. So that'd be like healthcare and tech and consumer discretionary, those kinds of things, compared to 2023. Retail spending in November blew it out of the water again. And finally, it appears that the era of subsidized online services is continuing to erode. I know we all got the email that our Prime subscriptions are changing in cost or accept ads. For example, Netflix subscriptions are changing. I just got a text from T-Mobile that says, you're still included in Netflix, but now you're going to get ads. And if you want to pay a couple bucks, you don't get ads. So there's that. I know we've all seen return fees starting to come up. So anyways, maybe I just blew our punchline there, but it appears that online services
completely
are starting
spoiled.
to erode. I totally spoiled it. Yeah. Now we don't have to cover that. Anyway, so that's what we're going to cover today. And again, welcome to our first episode of 2024. How I've been working on this beard for a while, and I'm actually bummed that no one's brought it up yet. You know, maybe it's because we work remotely, and so we're on Zoom. So it's like, oh, you know, it looks about the same. But I actually was going to shave on that first Friday that we were all off. So it was like the Friday before Christmas, just to like, you know, clean it up, restart, and then come back in whatever that was, 9-10 days. And I don't know, one thing led to another, and one day went by and I didn't, another day and I didn't. Now here we are, another like week or two in. I haven't done anything yet. So I think I'm going to rock it for a while.
I'm ashamed to admit that I actually didn't notice it growing, even though we talk every day. My wife would get on me for not noticing little things too, or, you know, life changes. You know, your son probably thinks that a new beard is completely different stranger in his house. His dad isn't clean shaven anymore. So that would shake a kid's world. I don't I could tell you what the S&P is without looking, but I just don't notice things like that. My wife could dye her hair blonde, and I would probably go a few days without saying anything about it because I wouldn't notice.
I think it's one of my superpowers is I just have this like I notice things like that. You know, I notice little changes. I notice like, is that a new shirt? You know, like people that I see all the time. And it's just, I don't know. It's just something, it's a superpower of mine, I think.
Yeah. Well, things that I think we've noticed and celebrated a couple of times in different mediums, like on our newsletter and our blog, if you want to call it that. We did not recognize here on the pod that Chris was recognized for Shook research, and I'll explain what Shook research is. For best advisors in the country, also best advisor specifically in Washington State, and being recognized for that is pretty huge. Do you want to kind of touch on some of the accolades and how you're feeling about it, and I'll describe to the audience what that is.
Thank you for that. For everybody on the podcast, you won't see me blush here, so thanks.
Well, the beard's covering up the blush.
That's right. That's right. And the red shirt today will just emphasize it. So anyway, thanks for bringing that up. It's a super cool thing. So it was the Next Gen Award. So Forbes has a number of awards that they award to advisors, and they partner with Shook Research on it. I will say that the cool thing about this award is that it is you can't pay for it, and I think that's important to say. There are a lot of things out there that you can sort of influence and then put them on your shelf. And Forbes and Shook is very keen on saying we're not going to be influenced in any way. We're going to be very objective, and so I'm proud to be recognized in that way. The Next Gen Award is it's no secret that our industry with advisors is aging, and so the Next Gen Award is for under 40 advisors that have been around for a number of years. There's certain stipulations of revenue trends, new client growth, clean compliance record. There's a host of different things that they look at in order to then award their Next Gen awards to, and all their awards to.
I think it's a great accolade. Yeah, the compliance side of it too is the record of it, meaning you operate in a business of finance, you're dealing with people's life savings. It's highly personal, and I know plenty of advisors who have some kind of ding on their compliance, and I think Shook does shake some of that out, no pun intended, where they look for people who are doing business the right way, and combine that with the age limit, the age ceiling in our case, next gen, right? Anyone under 40. I think that's two rare things, right? People with clean practice, clean way of engaging with clients, doing it the right way. Easier said than done. I totally get that. But also being the industry that we're in, I would guess the average age of like the financial advisor pool in America is probably 55 plus. It's got to be.
It's late 50s, yeah.
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 So that's a huge thing to celebrate. I know we were excited when we were. I'm taking credit here too because I'm part of Chris's firm. So when we won the Shook Forbes Research Next Gen Advisors for the state of Washington, I think that's one, a pretty exclusive club, right? There were over 42,000 nominations nationwide, and over 3,700 of them were selected. And in the end, it was only 3,700 were moved to the next round, and only 1,400 nationwide were recognized as best in-state next-gen advisors. So it's a lot of advisors. That's actually really encouraging to see that many practicing advisors under the age of 40 really get any kind of recognition, nomination, and let alone winning, which is, it's pretty awesome.
Yeah, totally. Thanks for all that. And it takes a team. One of the things also that Forbes looks for is you have to have a team. And that is, I think, great. This is definitely not an island over here. Consilio is a bunch of people that all of us together is how we deliver our services to everybody. So
that's why I'm basking in some of the credit.
And you should be. My name might be on the thing, but my name would not be on the thing if it was just me here. And I think that's important to recognize. It is a team effort that then allows Forbes to recognize the really the firm is how I would see that. So thanks again, and thanks for everyone's support and commitment, and everybody that voted with their feet last year and joined our firm as a new client, and everybody that's been a client of ours for many, many years. Thank you.
Yeah, try to embarrass Chris in the next client meeting.
I love that. Yeah, thanks. All right, moving on. So, forecasting for 2023 versus actual. Hao, why don't you kick us off here? You have this Axios information here, and then I want to dive into this graphic that we have. So, why don't you kick us off?
Yeah, well, Chris and I last episode, I think it was the prediction sure to be wrong, and we were wrong on calling recession in 2023 because it was such an obvious thing that was going to happen last year, and it didn't. So Axios posted pretty similar assessment. They quoted the Bloomberg Economics, where 100% probability of recession, where they survey a bunch of
100%.
economists. 100%.
I mean, that was their first mistake. Don't ever think something is 100%.
Yeah, yeah, and I think we've said economists that are published or engaging speakers are pretty much wrong most of the time because they're predicting the future, and I think that's nearly impossible. Outside of my fortune teller, is just something even the smartest people are not good at because the future is so uncertain. And I think we've been trying to hammer that point home quite a bit.
You'll recall I was looking over all of our titles last year as I was posting a bunch of stuff and all the things we covered in the podcast. And, I think our listeners would know that we tend to be kind of a broken record. Like, things will generally go the right direction over long periods of time. And that's true, right? That's the only prediction that really comes to fruition. And that's why we would preach, let's stay diversified, stay in time in the market, not timing the market. All of that stuff is what's so key.
Even when we thought
investing
recession.
Success.
Yeah, our base case was recession. But we didn't say sell. We said, hey, be prepared for volatility. We got volatility for sure.
We were right about that.
But we never said sell. We never recommend that. Again, I got to be careful about that. Any kind of recommendation coming out of here. But we never say panic. And again, recession, our base case was similar to the 90s recession that no one talks about because it's so mild. And 90s were a great time to invest. It's always in hindsight, too, right? 2023 was a great time to invest. Pretty scary time to invest if we're looking at December 2022, because that was a rough year heading into the next year. And I totally get why economists were so down on the prospects of 2023 because it was ugly.
We knew that interest rates were going to go up. They did.
Yes.
And then the market went up. I mean, yeah.
We said something was going to break. Quite a few things broke, right? That you look at regional banks, look at First Republic and Signature Bank, and I can't remember the Silicon Valley Bank. Look at them. That something broke. Yep. We thought we were headed for a nosedive in March. We did pull back, but since June, when Chris and I called the bottom, I'm going to lump you into that one when I said consumer sentiment bottom. Yeah, June was the bottom. And I know we retested the bottoms in October, and it was a up and down year. And anyone who stuck it out or didn't really look at their balances, I think that was probably the best course of action because you avoided all this noise.
The market also, interestingly, was not really negative last year, right? It was up in January, back down, up, and then back down, and then back up right at the end of the year in the fourth quarter. So, like from an S&P standpoint,
sure, yeah,
I don't believe it ever really turned negative last year. Am I incorrect in that?
The low point was about 10%, and that was very short-lived. Yeah, very short-lived.
Yeah, I mean, had you called that and perfectly timed that extra 10% down and bought in, which no one would have ever done, of course you would have done better. But I think our case is, if you just were in the whole year, you would have earned not just the return of the market, but also the dividends that those companies pay over that period of time, which is what's so important about just staying in, because you're going to get a fine return and you're going to earn dividends rather than trying to hop in and out, because the likelihood of timing the bottom is very little. Our listeners know that by now.
Yeah, and if you hear us changing tunes on that, it's probably time to get our heads checked.
Well, we won't change tunes on that, so that's no problem. Okay, this is interesting. So back in December, a bunch of big banks came out and they said, this is what we think the market's going to do. And just like all of our own sentiment, right? Everybody thought that things were not going to be good in 2023. So Barclays, Morgan Stanley, Citigroup, B of A, Goldman Sachs, RBC, JP Morgan, Wells Fargo. Barclays was the most, I guess, bearish. They said a -4% return on the year. Morgan Stanley said +1. Citigroup said +1. Bank of America said +4. Goldman Sachs says +4. RBC said +7. Bullish Canadians. JP Morgan said +9. Jamie Dimon, I guess, was bullish. And then Wells Fargo said +12. What did the market actually do, including all dividends in 2023? +26. So everybody was wrong. And how I want you to speak to this a little bit more. I believe you have some insights on how these predictions or when these predictions can be revised so that they like how does this work?
Yeah. Well, let's start with what their business is to gather more and more money, right? These are all big banks that are very interested in gaining new clients. And what Chris's list showed was not a huge glaring sell signal, right? Outside of Barclays, down 4% for the stock market heading into 2023. You could probably live through that. No one's really going out on a limb saying we're headed for a repeat of 2022. We're down 20% in next year, right? In regards to 2023. So how that works is, one, they're first and foremost asset gatherers. And it is a little bit of a game where a forecast is based on accuracy by year end. And who's checking on this accuracy? It's big funds, right? Pension funds, sovereign funds that are, if they're not happy with their current investment group, they're going to look for the next best thing or the next most accurate firm. The dirty little secret in our industry is all those firms that made predictions. I bet if you Google them, you wouldn't be able to find those figures that Chris pulled, because the article that Chris cites actually went back in December and locked those predictions in December 2022. So the dirty little secret is those firms were all allowed to revise their year-end predictions mid-year or later. Right, so if I only had a year-end prediction with only 6 months left to go, I'm going to be pretty accurate, especially around June where things were looking pretty good, and I'm taking my 4% forecast and I'm raising it to 15, 16% because the market's already doing that, and I'm going to look like a genius, and therefore I'm going to attract more money after the year ends because I look accurate relative to my peers.
What's interesting about this, and everybody's in asset gathering, but I think that means different things to different companies. I mean, we're in the asset gathering business, right? We want new clients. We want to grow our firm. We want to attract, like-minded clients in our niche to our firm. The only one in this list, I was gonna highlight Morgan Stanley. Morgan Stanley is first and foremost a wealth management company. They're huge. Yep. All these other ones are banks. And so I think what's interesting is, say, Bank of America, their primary business is banking and lending. And then, of course, they also have their Wall Street business, their trading, their M&A and all that kind of stuff. And so I know that, when M&A activity goes down like it did in 2023, the earnings swings of the big banks swings dramatically because tons of profits comes out of that wing. But it's interesting to me that, say, Bank of America or Wells Fargo would really even, I guess, care about making a prediction like that because they don't have as big of Wells Fargo is pretty big too, but don't have as big of wealth management arms. It's mostly banking and lending. So why do you think they care necessarily to put a prediction out there when their primary business is not really have much to do with the market?
Yeah, I think Goldman Sachs and Wells Fargo are very different places right now. But if Goldman Sachs were to shed business, Wells Fargo would be happily picking up the scraps there. So I think a part of it is in those banks that primarily don't deal in advisory. Wells Fargo does have a large institutional side to them. It's not as big as Goldman, but establishing a historical record, I think it would be important for them too. It's like, hey, we said this back in 2023, 20 years ago, Mr. Institutional Client, we have established, track record of accurate forecasts or semi-accurate forecasts. And I think that they're playing the long game there, maybe. I don't know what they're thinking, but they all have in-house research. Bank of America has Merrill Lynch as part of their umbrella, and they obviously want to appease their client base by setting out some kind of roadmap for the year. And I think it's important that they didn't, collectively as a group, maybe outside of Morgan Stanley, did not set panic into their clients, at least by these forecasts, right? They were still positive on the year, not as positive as 26%, still way off, but I think that's what I look for in a forecast is some sense of responsibility. You do see people like Rich Dad Poor Dad, who are saying, 50% sell off. He's not managing any money. You could say certain things without repercussion other than people taking jabs at you on Twitter, right?
Sure.
And I think that's where, when you're looking at forecasts, you got to look at where it's coming from. And that's why I started with the whole asset gathering, focus, because that's really what they're trying to attract ultimately, right?
Well, there you have it, everyone. The 2023 predictions versus what actually happened.
Yeah.
What's the lesson in this? It's really hard to predict what markets do.
Yeah.
That's it. There is some interesting information here on what happened in 2022 and what happened in 2023 per asset class. I want to highlight just a couple of these and how I want your thoughts too.
Sure.
There's only one on here that was negative both years. So in 2022, Chinese stocks were down 22%. 2023, they were down another 11. And then on the other side of the spectrum, you have U.S. large cap, which, as we all know, is heavily, heavily weighted in giant tech companies. Tech did not have a good year in 2022. That brought U.S. large cap, which is the S&P, down 18% in 2022, and then up, roughly it's 26, 27% or so in 2023. What else do you see on here, how that's interesting? Let's just highlight a couple of these for our listeners.
I think broadly, the impact that Chris mentioned in 2022 with U.S. large cap, the majority of asset classes essentially clawed back what was lost in 2022 outside of China. The biggest one that is more positive than anything was Japanese equities were down 2% in 2022 and then up 25% in 2023. So not only did they keep up with the U.S. markets, they didn't shed nearly as much in the previous year. And I think that's showing, one, how easy money policies when everyone else is tightening is such a benefit to your economy, right? Japan notably has kept their policy rate at 0%. I say policy rate because they don't have a federal funds rate like we do, but they do have a central bank that sets rates. And their bank rates are 0 to negative, and that's actually spurred quite a bit of travel and an economic boost, specifically manufacturing. I think that's been a huge boon for them.
I also think it's interesting, energy. Everybody remember when oil spiked in 2022? So energy was up 39% in 2022, and it was flat in 2023, which is actually interesting because gas prices came down, I thought, but I guess energy as a whole was flat. The sector, that is, the stocks. Yeah,
and we've said energy is cyclical. What that means is the prices that go up, like lumber or copper, they go up to a certain level and they go back down. Mm-hmm. And it cycles back and forth because the price of gas doesn't go up like a Google. It doesn't go up to the sky. And people tend to forget that when gas prices are $6 a gallon. I totally get that. But if you're going to look from an investment lens, you don't want to own an asset that goes up and then back down. Because all you're doing is round tripping year in, year out. It doesn't really help you grow your nest egg.
So 2023 as a whole was the 15th best year in market history. Man, where's that prediction? 15th best year? Didn't feel like it.
No.
But as a year-end return, that's where it was.
Yeah, and I think that's why we're harping so much on forecasting, because there was quite a bit of scaring going on in the last year, because this was going to break. The Fed's going to throw us in recession. It's going to be the U.S. debt is going to cause a recession. So many reasons not to invest. But then we turned in A plus for the stock market performance, right? And you don't get past returns, right? If I were buying the S&P today, I don't get that 26% return. It's if I buy the S&P now, it's the unknown, and that's what shareholders are typically rewarded for, is that element of uncertainty and risk.
I'm trying to find where was the 10% pullback? I'm looking at this chart here, and the green line, of course, is the S&P performance.
Yeah, I'm going off the JP Morgan Guide in the Markets. The market lows.
I remember seeing that too, and it was a -10. But when did that happen?
I believe it is in March, but our charts show continual growth. Most likely, there was a dividend that paid in March, but again, when you're dealing with different data sources, it's gonna show different things. Right. But if I go percent off high on Y charts, it hit. Oh, and the 10% hit in October. 10%.
Yeah, that was a correction.
Yep.
All right, moving on. Retail spending blew it out of the water in November again. What do you think? Can this keep going? And what are you seeing there?
Yeah, well, 2 episodes ago, we were talking about people finally being tapped out, right? The savings rate has just skyrocketed in 2020 and just depleted really fast, right? We thought that was unsustainable in terms of purchasing power, plus the amount of noted tourism going on. So you have all this travel, all this spending on cars, big ticket items. And, I think an educated guest back in September was saying, hey, this upcoming holiday season has very short life relative to what we think is left in spendable dollars. Apparently we were wrong because, and I say we didn't say, we don't really comment on retail spending in terms of a macro sense, but we were wrong. I think November, we're still waiting on December, but it looks like all signs are pointing to people spent a lot of money. It's not like a lot of money during this Christmas season, and they're still spending. I don't know if you've seen that Target partnership with Stanley Cups, these metal cups that are like...
I just read about Stanley.
Yeah, like these women are fighting over these pink cups.
Yeah.
There's videos of it. I don't know how much they go for. I haven't really cared for it, but...
I guess the key is that Stanley, as a brand, had initially marketed towards...
men, right?
Men, and then like they built these, thermoses and these, they were indestructible products, but they were always the same color, right? Like all of our parents had a Stanley thing in the house, Stanley mug or whatever, thermos. And then they rebranded, and they rebranded to women, and they 10x'd their sales.
Yeah. Which is
unbelievable.
Cool to recognize like an underserved group for your product. But at the same time, I think they're pretty expensive cups. Again, we could Google
all those insulated cups are to me like $5 more than they all should be.
But post Christmas season, and you got to scramble for these cups that are pretty expensive from my point of view. It shows that there's more there's more life to the spending. I know it's just one example.
You got to be a better consumer, man. You gotta get in line for these pink cups.
Yeah, I know. You should watch the video. There's some pretty funny fights over it. But again, hopefully no one gets hurt over just a really random thing. But I think that we're always going to cycle through these really popular items. But just broadly speaking, the amount of spending that's going on, and then all of a sudden this flurry for the cups, just shows one. If the consumer suddenly stopped, we would get a recession, but there's no sign of slowing down at all, at all.
Consumer sentiment jumped as well. We talked about this, I believe, on the last pod. Gas prices came down. It seems like gas prices are correlated with how good or bad consumers feel, because they go to the pump, they fill up, and they're like, oh my God. Or they fill up and they're like, it wasn't too bad. And then they feel good or feel bad based on that gas bill, and then they have more or less money to spend on other things. So I think gas prices coming down has helped consumer spending.
Yeah, I think so. And I think consumer sentiment, like gas prices, are cyclical, except in the opposite way, right? Consumer sentiment doesn't stay in the 40s forever, right? Mm-hmm. It bounces. And we say invest when consumer sentiment is low, and it tends to work out. I think the bad feelings don't last forever. The good feelings don't last forever, right? Because when things are going good, something unexpected hits you on the side of the head, and all of a sudden you're feeling bad again. So I think we're just trying to moderate some of that out.
Interesting. Well, 2024 being an interesting year. We will not predict what the market does this year because we don't know, but we generally feel like over long periods of time it goes up and to the right.
Sure. Yeah.
And we're going to continue to parrot that here on our platform, and we will be right. I don't know, 60% of the time, which is good enough for us.
Yeah.
Let's shift to our last topic here, which I totally blew at the beginning. The era of subsidized online services continues to erode. I know we had some stuff in the deck here, and so I just wanted to breeze over it. But I'll start here just by saying I know that we all, assuming all people are Prime subscribers, which I think many are. Everybody got that email that said, "Hey, Prime's going up." It was like what, $2, $3 more a month if you don't want ads on your video. I just got one, like I said, from T-Mobile saying the same thing, like, "Hey, we still got Netflix, but it's going to start having ads, and if you don't want ads, pay some money." In addition to that, returns are starting to cost some money. I actually haven't seen this yet on an Amazon return, and how I'd be curious if you did. I thought they were going to hit me for sure. We ordered some kind of big, just like bulky items maybe I'll just tell a story because better for context. I was trying to get my wife a new suitcase, but kind of just ordered the thing, figured this size was good. It was like a carry-on suitcase. That's what we need. So it's kind of a big item, right? It's not heavy, but it's just a bulky thing. Shows up, too small. Order a different one, way too big. Order a third one, got it right. So I ended up returning 2 suitcases, which are big, bulky items, right? And I thought for sure they're going to hit me with a return fee on this. And they didn't. So I haven't experienced that yet. But
yeah,
I don't know if you have.
policy change is a little tweaked in terms of Amazon. You can return things through the UPS store with just your Amazon label, and UPS store, no problem. The UPS guy will pick it up. Those drop-offs will cost $1 if Amazon determines that you're closer to a Kohl's or closer to a Amazon, and closer to a Whole Foods. So instead of dropping off at a UPS, they're encouraging you to drop off with their partner stores, which makes more sense because UPS will say, well, we're shipping this back to you. We're going to charge you versus Kohl's or Whole Foods. So that's one thing is returning things via Amazon isn't some costless transaction, right? And Amazon foots the bill of the UPS driver or the UPS shipping cost, right? So that's one cost. The cost was a bit of a subsidy through Prime Video where they paid for all this content as part of the lumped-in service, and they're suddenly realizing it's more expensive to operate and produce original content than what they're charging currently. So the option is watch ads or pay another $3 a month to avoid the ads. We're not picking on Amazon by any stretch. It's
everybody's doing this.
Everyone's doing it.
Is this a product of the writer's strike and having to pay more money for content?
Probably looking back a few years, it's probably a product of easy money policies and customer acquisition strategies where, Netflix out of the gate was what, $8? No, not even that, right? $5-6 a month.
$5.99, $6.99. Yeah.
So let's reverse it back. And Netflix, yes, they have a customer acquisition strategy, but they were unwilling to subsidize any lost leaders, meaning we're going to charge you what we're paying plus a spread, right? So we're going to charge you fair market value. Let's say they came out of the gate at $10 a month. Would they get the subscriber sign-up that they got back in 2013 or 2014? I doubt it. And their position of power to jack up prices, because Netflix is another one where, as a Netflix subscriber, I think we've had 3 price hikes in the last 2 years or so. Like, they're coming pretty frequently now. And I think
I would argue that Netflix has the best content, though. So I think if
and
maybe they needed to get people in at a low price in order to prove that they had the best content and then raise the price. But I mean, if they could have somehow proven that, and $10 a month is still like, there's so many things out there these days that are like $20 a month.
Yeah.
Peloton's $50 a month. That's a lot, right? Pay less for I guess I don't watch my Netflix, but
I think Netflix really paved the way for that kind of subscription value, right? Because everyone was so used to physical media on a DVD or Blu-ray, where streaming it over the line, it was met with a lot of doubt. It was like, well, one, I don't have high-speed internet. How am I going to watch these shows with any kind of quality?
Yeah.
But then that opened the door to, CNN Plus. They charge you $8 a month for CNN. Well,
ESPN Plus, all of these.
So it just made all these things like TiVo suddenly acceptable, right? TiVo.
Oh, man.
TiVo changed the way people watch TV, but it was met with a lot of doubt. It was like, well, am I paying for something my VCR could do? And again, for younger kids, VCR is a cassette player. So VHS tape. So that we used to record shows on that, and TiVo was second thoughts. Like, why do I need to record shows when I have something that I just press record when the show starts, right? And you didn't think about how much life-changing that was.
You could watch a 60-minute episode in like 46 minutes or something. Like I remember when you would buy stuff on
home to hit record.
Because you buy, you'll buy a series of a show or something on Amazon, for example, and an hour-long episode is 47 minutes. You're like, well, I just got 13 minutes back of my life, which was previously just commercials. Like, this is awesome.
Yeah. So the customer acquisition is huge with ride sharing too, right? Like Uber and Lyft rides used to be, very, very cheap relative to a taxi because their goal was to divert customers away from taxis. And now that they're suddenly having to make money, I know, which is so crazy to say in the business world, they have to raise their prices to fair value to pay for gas, for labor costs, whatever the cost inputs are. That has to be paid eventually. So going back to the writer strike, the actor strike, yes, they're saying all these big corporations making a lot of money, and they're still getting a very small percentage, relatively speaking. But again, we don't know what subscribers are really watching because Netflix doesn't report who watches what. So there's no way to divvy up a fair share of who really drives viewership.
It's super interesting. So you're saying higher interest rates puts more pressure on the company to produce profits, which puts more pressure on prices, which ultimately
inflation
trickles down to my Uber app and why it cost me, I think it cost me $100 to get to, this is a while back, we went to a wedding in like Capitol Hill and we live over on the east side. And it was like, $100. Jeez.
Yeah.
It's like
that's like a third of a car payment. So
insane. If you're like however many percent of Americans that have $1,000 car payments, it's only a tenth. But anyway,
for one ride though,
that's really good perspective on that, because then it also boils down to all of these other services that we all subscribe to for free shipping or all this other content stuff that we have.
Yeah, that was all subsidized years ago, and now the subsidies are ending.
By low interest rates.
Because,
Well, and Wall Street has said, hey, go ahead.
Yeah, Wall Street, sorry, go ahead. Wall Street's saying what?
I was just going to say that Wall Street has said it's okay to not make money and we'll still reward your stock price for so long.
Yeah.
And now Wall Street has said, no, you need to make money. Show us your business model. And Uber stock has done well last year because really they're actually profitable now.
Yeah, and
interesting.
I think a component of it is we're seeing inflation because things were so artificially cheap back then. So were we going to run into this, COVID or not? And I would argue yes, because eventually the bill comes due, and if you're a business, you got to show profitability eventually, right? Like, what are we doing here if we're not?
Well, they all project it.
Yeah.
They project it in the fourth quarter and then they never hit it. I shouldn't say that. That's a totally bearish statement because oftentimes companies do hit it.
Yeah. Or if they don't, they get punished, right?
Sure. Yeah.
Eventually.
Because the stock is overvalued based on that prediction. And then if that doesn't happen, it tanks.
Exactly.
Super interesting. Okay. I'm glad we touched on that. That was interesting. I learned something there. Thank you for that. All right, everyone. We are out of time for today. Thanks so much for tuning in for our first episode of 2024. If you're not yet subscribed to our podcast or YouTube channel, you know what to do. Hit that button. Hit the bell. Hit the thumbs up. Hit all the things.
Comment on the beard, too.
Comment on the beard. Forward this to your friends. and tell them about us. We would love to continue to see people voting with their feet by joining our firm as clients in 2024. And we welcome that, and we're excited to continue to serve our community of tech professionals and retired professionals. Thanks, everyone, again, and we'll catch up soon.
Make it a great one.